There we go. There. I don't know. It's usually Instagram or Facebook that's causing me problems. Welcome everybody, your backup plan tribe to tonight. I'm happy to be on, and it would be devastating to have a whole video done and find out that you don't have any sound. So please like, share, and subscribe to our channel. My name is Tina Ginn, and welcome to our channel. I am an emergency preparedness coach, a best-selling author, a financial expert, and an app developer of Your Backup Plan app. And I'm located here in Vancouver, chilly but sunny today in Vancouver, BC. And we post step-by-step tutorials, sometimes current events in the news, some tips and tricks with our weekly interviews and whatever else I feel like posting. You know, I can't get enough, I'm sorry to say, I can't get enough of our podcasts. They're such excellent people that I come across, excellent, unbelievable stories. And I'm so very grateful for having each and every one that's able to tell us their story. And we can, as listeners, can really love and appreciate that there is still inspiration and motivation and survivorship out there for all of us, especially during this time. I interview real people. Real life people with their real life stories that they share with us each and every week on our podcast. It's on 10 different platforms now. And our live broadcasts are every Thursday. And it's just a review, a simple review of questions, answers. If anybody comes on, has any questions, you can feel free to let us know. Not sure if, I think it's on. I'm not sure. Let's try again. Sorry, I'm just going to try this one more time because I'm not sure if we managed to go live or not. Crazy. I have one trouble, then I have the other trouble. Okay, let's try that. There we go. So we got everybody going on here, and then we're okay, right? There we go. Welcome to your backup plan tribe. I'm so happy to have you here tonight. Please give the video a thumbs up, or if you would like to share with your friends and family. Every week I explain what we do, and interviewing real life people with their real life stories to tell us all something that we could feel motivated and inspired to get better organized, because my passion is to help educate each and every one of you to get better prepared for the unexpected, because we should expect the unexpected. It sounds kind of funny, doesn't it? But our backup plan app puts your life all in one place in preparation for any unpredictable circumstance, while taking the painful aftermath out of any tragedy. What does that mean? That means that you could have a wildfire, you could have a flood, you could have a hurricane, you could lose your purse, you could lose your wallet, you could just be in the hospital for any length of time, longer than being able to pay your bills. So what does that look like? It's probably something that looks like every week, because we probably have bills either every week that we should pay or every month. And that's what that would look like. I help you put all of this together in one place so that you can weather the storms that come in our journey. Every year, it seems like we have something that hits us: a car accident, COVID, a medical operation, cancer, stroke, heart attack. I mean, I could go on. Wildfires, hurricanes. I was going to say tarantulas, but I don't think that's probably a tragedy for any of us. But today we were discussing mortgaging and refinancing during COVID. And, it's a fun topic. I call it a nerdy topic because, well, it's numbers and it's financing. And so it's a little bit nerdy, but hey, we can get some tips and tricks out of this. We can all benefit from having the opportunity to better understanding your contracts, being able to shop and get better prices. Perhaps it's interest rate, perhaps it's term, length, amount, all of that kind of stuff. So it's really, really important that you understand what you're getting. And how do you do that? Well, let's start off with this week's, I always say a quote, and I have a quote tonight. And our quote is, "The best and most beautiful things in the world cannot be seen or even touched. They must be felt with the heart." And you'll never guess who said that. Helen Keller. Isn't that amazing? So what is refinancing? What does refinancing look like? And how do people shop for their mortgage? So what I wanted to suggest to everybody is, after hearing this, maybe making some notes on a piece of paper, you could then pull out your contract and really look at what did you get, because there might be some advantages of refinancing. There might be advantages to staying with what you have, but it all depends on what other credit cards you have, what other debt load you have to put your mortgage in place. So what is refinancing? Well, refinancing is revising or replacing the terms of your existing contract, usually a mortgage of some sort. And we all try to find the best interest rate, but guys, that's not everything. The best interest rate is not necessarily everything. You should consider all aspects of it to look at the cost of it monthly and the cost over the length of period of time that you'll have the mortgage. We discussed in one of the podcasts this week, I had mentioned, I remember, and it's a while back, growing up, and I would have friends of, parents that would have a 25-year amortization. And what does that mean? It means that the length of the term, the length of the mortgage is a full, could be 25, it could be 35, it could be 40. It depends on what country you're listening from, but look at what your amortization is. Is it 10 years, 20 years, 25, 35? Because that's how it's calculated to what the interest rate's going to be, is they use that in the formula. So when we used to have 25-year amortizations only, and people would buy a house, this would be, what they would normally do, and have a 25-year amortization and have a huge party after at the 25-year mark, and they paid off their mortgage. They wouldn't move or anything during that time, and they had a huge lit the mortgage on fire and burnt the mortgage. And I remember doing that for quite a few of my friends, and it's just, it's craziness now, because we're just not in that place anymore, where we don't usually try to get rid of our debt. We seem to either, sometimes we buy down, or what we usually do is buy up in properties. And then it seems to have an effect, of course, on the less amount that you have mortgaged. So the mortgage seems to be increasing. Your property is increasing, but your mortgage is increasing instead of losing your mortgage, so to speak, paying it off. We never seem to pay the darn thing off anymore. We don't have those burning mortgages. We're using mortgages now for so many other things. For example, we mentioned talking about perhaps you could have a mortgage and a line of credit combined, so that you always have the line of credit and it was usually done at a bank or a trust company that can collaterally give you a line of credit, which means they put it against your mortgage. Your mortgage is against your property, and your line of credit is also as collateral against your property. So, but it's really nice to use it, if you wanted to refinance, if you wanted to renovate, if you wanted to go on trips, if you wanted to retire and you wanted some other way of paying for things every year, paying off credit cards perhaps, or buying into a business or partnership. And a lot of times we leverage the property, the equity in the property, and then use that against purchasing another rental property, perhaps something, whether it's commercial or residential. And it was leveraging, what I recall, came out in the 80s about. And it was really super, not important, but popular. And why it was popular was because it had a risk to it, of course. A lot of people didn't want to take the risk because if you buy another property, you would be responsible for that mortgage payment, and that's when the rent would pay for it or subsidize it, or and give you extra, hopefully, to put towards maintenance. But as we've gotten older, like in the 2000s, and now we're in 2020, it's become a tool instead of a leveraging risk. It seems like it was very risky in the 80s. The interest rates were quite high. And now with the lower interest rates, it's sometimes more beneficial to have like a line of credit and a mortgage and use that mortgage as leveraging for equity against another property, against a partnership, against a business, so that you can use that to build up more income. All of these types of things, sometimes even investments, sometimes it's better to borrow the money on your line of credit interest rate and then invest at a higher interest rate. So you can see that you could, it's a win-win usually in that case. It's always scary when the interest rates raise quite high, because we get worried about that time of leveraging. But normally it's been pretty consistent since the 80s, and it's really, really important to kind of look at maybe what you're going to be going into. And of course, you can't put all these kinds of things together, you guys, if you haven't done it and pre-planned, which I talk about all the time. If you could pre-plan for a line of credit or refinancing with your mortgage with an extra, that would allow you some extra funds that you have the ability to play with. If you don't and you're not working, it's impossible to put it together. So the other way of leveraging retirement, that type of thing, is a mortgage that's called a reverse mortgage. And what people do, I'm not sure what it is in the States, but in Canada, it's age 55 and over. You can usually use up to 80% of your mortgage for 80% of the equity of your mortgage, of your property. I should rephrase that. I knew I said it wrong. Okay, so if you want to leverage the equity in your property, you can then, sometimes you could do like a reverse mortgage, and those are really, really popular as well. We talked about loans versus line of credits. A loan is normally, if you have, you would have term, so you might want the loan for 2 or 3 years, and or 5 or 10. And that also uses an amortization, but it also uses the term, the length of the term, and it calculates a number. And it's also to pay back the principal. So you're paying interest plus principal. Whereas the line of credit, that's different because versus a loan, the loan is, like I said, it has the terms of the cost plus the principal that you owe on the balance. So let's say you borrowed $50,000 and in a year you still owed, let's just say $45,000. That would be your principal that would be coming down. But if you have a line of credit, you only pay for the interest only payments normally. And then that way you could then add extra of the principal amount to pay it down faster when you can. And that's the part I like, when you can, because during COVID, we soon very quickly came to realize that sometimes we don't know what's going to happen. And COVID hits, and now we have no job for 2 months. What do we do? So that's the time when you have it already set up, you could withdraw money from the equity of your mortgage if you had this attached line of credit to your how you set it up, or if you have a separate line of credit. And that way you could pay just the interest only payments. And then when you get back to work and you're working more, then you can start paying off that principal as well. So you pay interest plus principal. But that's why it's really nice to have something like that. Sometimes it's cheaper to pay down a car loan. Sometimes it's cheaper to buy into a partnership so that you could have some dividends from the revenue from the company. Sometimes it's beneficial to look at all of these aspects to see what suits you best and to understand your contracts of what you're getting into. Because the other tip for your contract would be to be aware of the length of the mortgage, to be aware if it's collateral mortgage or not, to be aware of the length of the amortization, because you could increase it or decrease it depending on it. It makes your premium or your per month cost higher the shorter of the amortization that you have. That was a mouthful. So if you went with a 10-year amortization, it's going to be more costly because you're paying that loan off quicker. But the other nice aspect of really knowing what you have is if you can pay off some of that principal every year. How much can you pay off without being having extra charges put on your mortgage? Some companies do not allow you to pay down your mortgage more than 20% every year. Some companies don't have a certain number. So it's really important, can you look at that part too to see whether or not when you feel like it, you could pay it off quicker. Maybe work was good or you got an extra bonus or whatever, you could put lump sums down on the mortgage, and that would build up your equity of your property. So there's some pros and cons to everything, I guess, so to speak. So Jenna was our guest, Jenna Schofield from Jenna Jade Mortgages here in the Langley area in British Columbia. But you could actually go to any mortgage broker. And I really, really want to emphasize it's a good opportunity to get a mortgage broker or have a mortgage broker. And why? Because they do all the shopping for you. So you bring your paperwork in basically to them. Here you go. Here's everything you asked for. And then they take that information and they put it out to 3, 4, 5, 6 different companies. And then they wait to see what comes back. And that's what you would get approved for, and you can choose then which one suits you best. But if you're going around shopping at each institute yourself, you might not be comparing apples to apples. You might be comparing apples to oranges, and that makes it more difficult because remember, a mortgage is not just interest rate. Remember, that's only a small little portion. Can you take the mortgage with you if you move or decide to move? If you don't want to stay in your property for, less than 5-year term, what do you then do? Where do you, can you take the mortgage? Do you have to pay it off and then get a new one? Or can you transition it to the next property? Do you want a line of credit added on to that mortgage so that when it gets registered at the title office, it would have a bigger amount than what just your mortgage amount is? It would be, let's use an example. If you had a $500,000 mortgage, then your registration, your title of your property could have, a $600,000. What they do is they blanket it. And then you'd have that extra $100,000 as your line of credit. Now, you're not charged anything if you don't use it, but if you use it, you're charged interest-only payments, and then you can pay it off as quickly, as fast as you wish. So, what gives you good ratings? Well, I'm sure everyone would be able to tell us that, because that's pretty simple to know that A, you should use a mortgage broker and shop around. Right? You should get more than 3 or 4 different mortgage ideas, some concepts to see what works best for you. It's a really good time to finance right now. If you were working full-time, have a letter of your job, and usually 2 verification of incomes on your, like a pay stub. And what else? That's pretty much it. It's more if you have a small business or small business revenue, but you could refinance when you could combine a mortgage with a line of credit, say, or you could refinance the whole thing plus perhaps consolidate some of that debt into the mortgage. Now, remember, if you consolidate debt in the mortgage versus outside of the mortgage in a line of credit, you are paying that amount. Maybe it's $20,000, maybe you put on $30,000, you want to, add it into, to refinance the whole thing, your mortgage plus that debt. It might be beneficial to look at, instead of into the mortgage, but separate, but on a line of credit where you can just pay interest only, and then you can up the amounts that you want to pay down your principal on your own. So one month you might, the next month you don't. It's up to you. So that's a really good idea too. Might be able to save you some money. It's a good time to buy when the rates are low, which is now. You will need to know what your credit rating is. And please don't go around shopping for cars, loans, line of credits. Every time they pull your credit rating, it puts a hit on your credit rating. And you do not want that, because the more hits you have, the more dings you have against your credit rating, and it brings it down. And it takes a while to build that back up again. So it's a really good opportunity to know what your credit rating is and have you pull it just the once. And then that way the mortgage broker can then shop around with that one, instead of you going to this bank and doing a pulling your credit rating, going to that bank and pulling the credit rating. As you can see, it starts depleting your credit. Sometimes you'd want to put a student loan that you still have. Perhaps you want to pay that off. You could you could consolidate it into your mortgage, or you could put it into a line of credit and consolidate your debt into one. So what kind of options are there for benefiting from the lower interest rates. That would be lowering the interest rate, whatever you can possibly find. The duration of the term of the mortgage. So how is it based on when does the mortgage come up for renewal? And that's usually at banks, it would, if we were to use an example, it'd be 1, 2, 3, 4, 5% for 1 year, 2 year, 3 years. So it depends on how long you want the term for. There's a variable rate and a consistent rate, basically. So you might want to look at, do you want it fluctuating as well, or do you want it consistent, a consistent interest rate for the length of the term of the mortgage? So as you can see, there's quite a few things that you can look at. Do you want the fixed rate or the adjustable? Do you want to revisit? If you don't have a very good credit rating, I would suggest that you get all of that kind of together and get some help with how you can build your credit rating. There's on my blog, which is at yourbackuplan.ca, there is a few ideas and concepts of how you can get your credit rating in a better standing. So you have to look at whether, if you consolidate your debt as well as your mortgage into one, is it beneficial? And is there any extra costs if you decide to get out of your mortgage, or if you decide to change your mortgage and go with another company? Normally, if you go into one bank and you ask them to refinance this, you're still obligated to that term of that mortgage, the length of period of time. Like when you insure your car, for example, are you going to insure it for the whole year, or are you going to pick, 6-month window? That's the same kind of idea. And the bank is not going to look at you very favorably if you don't if you want to change your mortgage before the term is up. So it's a good idea to consider those extra costs if those are involved. I think it's really important that you understand your contracts and understand, can I get out of this mortgage without a lot of costs? What would that look like? Do I think that I would move anytime from the 1 to the 5 years? Do I want it flexible? Those are all kinds of things that add or subtract to the cost of your mortgage, but they're all variable according to the companies that you are getting prices from. So it's good to consider those aspects. So if we want to do a summary of those types of things, it would be using a broker has the ability to shop for you versus you doing all the shopping at different institutes. Number 2 is, what is the interest rates? What is the length of the term of the mortgage? What will that give you? How long do you want that to be? Do you want a fixed rate or an adjustable rate? Do you want the mortgage fixed? Is there going to be costs involved if you cancel the mortgage or change the mortgage in the length of the term that you've decided to pick? Can you pay off the mortgage? How much can you pay off every year? Can you transfer the mortgage to another property? Say you wanted to keep the mortgage, but you just wanted to move properties and you wanted to buy a different property, and you could, some companies allow you to port that mortgage over to the other property. So if you want to access some of the equity of your mortgage, that can be done when you can pull that equity out. And as I said, a quick summary for the equity that you could use it for is buying rental property, buying into a partnership, buying a small business. What else could it do? Pay off student loans, consolidate your debt. I'm trying to think of all the different things. Sometimes you can get a better interest rate and you can pay off that debt as quickly as possible. So those are all kind of common reasons to consider refinancing or consider getting a line of credit. Now, with the line of credit, you do not have to make any payments. You don't have on the line of credit, you only have to make interest-only payments. So that's really important when you have to look at, well, I have so much in debt, I have so much in credit cards, and it would actually cost me X amount every month instead of doing it this way. So you might as well save money where you can. What else did we talk about? We talked about line of credit, secured and unsecured line of credit. So if it's against a piece of property, so you have there's some collateral there for the bank. There's pay only, interest only. You can pay some of the principal as well. You can use it to pay, consolidate debts, retirement, traveling, business needs, renovations, that type of thing. Maybe you want to help pay off your children's or grandchildren's education. So that could be used for that as well. What are the advantages of COVID right now? Well, you guys, you tell me, what are the advantages? One, if we're talking about mortgages, is the lowest interest rate that I've seen in a very long time. So if you can benefit from that, hey, you might as well look at what you have right now and then compare what you can have, what the other possibilities are. And you have to do it just like any planning. You will have to plan for this ahead of time. Sometimes it's a good idea to get pre-approved so that you know how much you're looking for in a property. But usually what I always say to everybody, it's good to have good credit, use the equity that you have in the property, make it usable for yourself, use it to make more money in whatever shape, form you can. And I'm sure that you'll find that it's very beneficial. Keep a good credit rating so that, and then you need the down payment as well, but it's always good to have proof of employment and good credit rating. Do not try and get this after you retire, because then it's only based on your retirement income. So if you set up, for example, a line of credit when you are still working and then you retire, it will stay there with you and you don't even have to use it, and it doesn't cost a thing. So it's really good to pre-plan and get that in place before you may need it. What improves your credit score? Well, you pay your bills on time or early. Utility and phone bills add points to your credit score when paid early. Keep balances low when possible. The lower, if your balances are going down, you build up better credit as well. Only apply for new credit when needed, because every time they check your credit rating, it takes a hit on your score. So always ask, because there's a soft touch and a regular credit rating. If you do the soft touch, it doesn't do anything to your credit score. If you do it the regular way, it does. So you can't be going from institute to institute to institute getting costs of a mortgage, because they're going to run your credit rating every single time. What else did we talk about? I think that's about it. There was probably a few stories in there with Jenna. She's had a lot of experience with business financing as well. And her links are down below in the description. And you can go over to my profile and you can get the links for the blog and the podcast as well. So I hope it wasn't too heavy. It's a very nerdy topic and I probably just talk too much, and maybe I'll watch this after and say that didn't make any sense at all. So I hope you guys did get something from it, and that you'll stay tuned next week on our new podcast that comes out. And I really appreciate all your likes, shares, and subscribes. So if you haven't hit that red bell down there, please do. And share, please share our stories and our videos with your friends and families, because everyone's in the same boat of not being prepared. And that's what we're here for. I'm here to help you guys out in doing that. And I really appreciate everybody's like, share, and subscribes. I appreciate your comments. So feel free, if you have any questions, send me a note. And I'll end it at that. I think that was quite a bit for tonight. And I always end my videos and podcasts with a Carol Burnett sign off. So stay safe, wear your mask, and wash your hands. Please stay safe over this month of December. We're almost there. We're almost at the vaccine point. So you guys take care of yourselves. And we want you here next week to listen to the next podcast and videos. So I'll end with Carol Burnett. So thank you guys. Thank you so much for liking, sharing, and subscribing to our channel. I'm so glad we had this time together just to have a laugh or sing a song. Seems we just get started, and before you know it, comes the time we have to say so long. Good night, everybody. Stay safe and be healthy, and looking forward to next week, seeing you all here again. Bye for now.